back. You're watching the ET Money Show with me, Kavita Thapliyal. Continuing the debt theme, let's talk about fixed deposits now. Now we all know that millennials hate fixed deposits, and most financial advisors ask them to stay away from it as well. But is it time for us to rethink about it? Because this is one investment avenue in the debt space which has become attractive due to rising interest rates. So, as an investor, should you be parking your money in fixed deposits and taking advantage of high interest rates? To help you guide through this dilemma, let's bring on board Suvajit Ray, Head of Products, IIFL Securities, and Arnav Pandya, Founder, Moneyeduschool. Good evening and welcome to the show. Suvajit, first of all, your take on fixed deposits being attractive now. Should one be locking in their money, making the most of this high interest rates?
FD in now has become a real good instrument to invest, and in my view, till next 18 months to 24 months, the time when always there has been a repo rate which has increased, and the total rates which has gone up, and in this current scenario, FD has become really a good saving tool. And most importantly, this is one of the very secured way of investment. And for millennial, not only millennial, I will be also suggesting for a lot of aged customer who are into the retirement age, are the people who are looking for a very sustainable amount of an income and periodic cash flow from the monthly or quarterly or annually. For this kind of an instrument which can give you a real good heads up into the a real fixed income. And if you see, starting from the banks to small finance bank to the corporate FD, the ranges it's pretty huge. Even in some occasion, in case of corporate FD, you will get as high as 8.3%. Some small finance bank you will get at as high as 9%. For senior citizen, you get 25 bips more even. So in my opinion, yes, 18 months to 24 months is time where investors should look for one of the asset class as AFD to invest in.
One thing very interesting that we are noticing is, Arnav, that there are attractive rates for a particular tenure. You know, you can say like for 15 months, and some have like for 549 days. There are specific period or number of days which have higher interest rate. What's the logic behind that and the reason?
So if you look at these kind of offerings, these are mainly from banks which give you a specific rate for a fixed time period. Now, one has to understand the business of banks, which is that they borrow money, a lot of, or rather a huge chunk of it comes from fixed deposit, and then they lend it out to various borrowers, be it individuals, corporates, and so on. So every bank has a specific time period for which they are lending out a higher amount of funds. Now, it is not necessary that for that same period you are getting a fixed deposit. So if this thing doesn't match, in banking parlance we called it an asset liability mismatch. So banks who have a huge need of funds to lend for a particular time period, they are more likely to give you these kind of special offers, whereby for a specific time period you get a higher rate of interest. So for example, there can be a bank which offers say 666 days a fixed deposit, which is higher at say 7.5 as compared to the highest rate for the other periods, which might say end at 7.25. Similarly, some other bank might require money for another period, so they would have say a 549-day offering, somebody will have a 725-day offering. But the logic is this, that the bank needs funds to lend out for a specific time period, hence to attract more investors to invest for that particular time bucket, they are giving you a higher rate to attract you to put money for that and not for some other time period.
Now, since we know that there are such attractive rates being offered, how can we make the best use of it? Yes, definitely you should park in, lock in these rates. But then when we talk about financial planning, Suvajit, when we talk about diversification, when we talk about goal alignment, how can we make the most of these rates in terms of aligning this with your goals?
completely depend for one any investor. Say they have to choose it very prudently. Whether I wanted to lock my income for 8.5% or 8.3% for the next 3 years or 5 years, or probably for going for a secured debentures option. Uh, it's purely the cash flow that a person should look forward, that they wanted to fix it for that entire asset class. Because I believe that in Indian context, that if I talk about, dates plays a very significant role, and any fixed income products like FD also plays a very significant role. If I in a total quantum talks about the business for FD put together, bank, corporate, and any other put together, that number is significantly high in compared to any other businesses. So I completely believe for an investor who is at a range of say 25, 30, they should be looking at a little more riskier instrument. A person who is entering into on the second age, or which is pretty much near to the retirement, looking forward for a fixed return instrument, which could be an NCD, a little more a little more risk, which is carries into that particular asset class. And in case of the person who does not want to have any risk in this asset class, should go for a FD. But at this current moment, it's a very critical. If you analyze over last 15 years, you will find this kind of a rate of interest. And I believe that for next 18 to 24 months, where people can actually look for this kind of a rate of interest, and should not forego the opportunity to grab this, and for which I believe at least 5 to 7% of the asset allocation of the total overall asset should be invested in this kind of a fixed asset classes.
Scenario which I really want to discuss, Arnav. Now we are seeing that FD is offering you a very attractive interest rate, and so the interest is also up for your loan. Your EMI has also gone up. How can we make the best use of this mode of investment to repay your loan? Is there a strategy?
So, I mean, if you look at the numbers, the position is very clear. You have to look at what you are earning as compared to what is the rate that you are actually paying. So if you say have a floating rate loan, specifically for say you have a home loan, which is a long-term loan, and you have recently taken it recently, meaning say last 1 to 3 years, then what you will experience is that you will have a longer uh, amount, or rather a longer period left in the loan, as well as a larger amount which is left. Now rates on housing loans, which were say around 6.5, 6.75, they have gone and crossed over 9%, because of the fact that these loans are straight away linked nowadays to repo rates or other benchmarks. And because of the rise in the overall interest rates in the economy, these rates have gone up. So, in effect, the cost for borrowing for a a borrower who has taken this kind of loan is very huge. As compared to that, now you look at the amount, say, which you have and which you might be thinking of parking in a fixed deposit, or maybe it's already a little bit of it is there. Now, the earnings here is actually lesser than what you are earning, or rather what you are paying on your loans. So the logical and the most best way to tackle this situation is that you can have some amount which you have taken from the FD and which you can use to repay the loan. And this is specifically beneficial if your loan is in the initial periods and you are repaying the capital, because of the higher interest rates, you will have seen that your tenure has gone up significantly. Now you need to bring that tenure down, and at the same time ensure that over the life of the loan you are not paying a very large amount. So if you are repaying in the earlier stages of a loan, it's a big saving, because you are going to save a lot of interest. Because the way amortization takes place in a loan is that initially a higher portion of the loan goes towards interest payments and a smaller portion is in capital repayment. As the loan period goes on, the balance starts shifting, and in the later parts of the loan period, you find that a higher portion is just plain capital. So repaying in the earlier part of a loan makes more sense. It is more saving in terms of the interest that you will have to pay over the life of the loan. So shifting some amounts which say maybe are maturing in an FD, or you have some amounts which you might be thinking of putting it in an FD towards this kind of repayment makes sense and is a smart strategy according to.
Vajit, what is your take?
So what I believe, to some extent, yes, I definitely agree with Mr. Pandey. But at the same point in time, I may not think that FD is a right instrument to hedge your cash outflow for your any loan, which may be your housing loan. Because if I compare the borrowing rate versus the lending rate, you will always find there is a gap between 150 basis point to 200 basis point. So yes, in having said that, any other fixed income product like debt mutual fund, some kind of a balance or a hybrid mutual fund can be worked out, where you can actually really earn more than what you are foregoing or what we need to pay, which is essentially somewhat around 8.5% to 7.5%. Even if you had a loan at 6.75% after increment of the repo rate, you will be at 8.75 or ranging between 9.15. So in that kind of a range, if you are investing into anything which is index fund or into the balance advantage or anything on the hybrid side, you will be very well fairly can get up to 10.5%. So from there, you can really plan out something. But yes, having said that, it is always a very, very tactical movement for any investor that paying the EMI, paying the principal is fairly a better opportunity rather than carried for the longer period of time. As Mr. Pandey have also explained that in amortization, your principal repayment happens very, very less. In the over next, after 10 years, if you are talking about 15 or 20 years of a loan, you will find closely 8 years to 10 years that only the principal you pay towards the interest rather than to the principal. So it is better that you should pay off a percentage of the loan to reduce your principal. At the same point in time, you can always hedge with mutual fund, which is lesser riskier. Not I'm talking about an equity mutual fund, but the debt oriented mutual fund. You can look forward to where you can get a very, very steady rate of interest, which can hedge your capital outflow.
Last question, because we haven't discussed corporate fixed deposits. Arnav, do you think it's the right time to make the most of it?
A corporate fixed deposit, I believe that a person should look forward, because you will find there are a lot of corporate fixed deposit right now into the market. I don't wish to take the name, but there are a lot of, but you or an investor should look and understand about the credit rating about that particular company. Because when you are making a choice, you need to have a very, very conscious decision about the rating. In the rating, you will always find double A or triple A, and also the outlook, whether it is a positive, negative. So one should invest in a way. It should not be looking at only at the rate of interest that you are getting, but you should look at the credit rating of that company. There are various companies which are raising capital through fixed deposit, and I believe there is a pretty much a safe tool on which people can invest. For a pretty long time, they are into the market. And if I talk about their repayment capabilities and paying the interest servicing on the time is pretty high. There are a lot of rating agencies have rated them in terms of the kind of capital that they can raise from the market, and based on the repayment schedule or the repayment capability for the last time, and based on which people can look forward. I believe that there are a lot of digital way now. This corporate FDs has started coming in, where customer can just on the click of a button that they can invest into a lot of corporate FDs. And I believe getting an 8.3% through a corporate FD is not bad instrument. If people and investor can definitely look forward. But yes, asset allocation is extremely important. You should not put at least 50% or 60% of your asset. I again try to emphasize maybe 5 to 8% or 10% is what you should allocate into a fixed income, and that to FD.
Sure. Thank you so much, Suvajit, for being on the show and helping our viewers with that today. And Arnav, you please stay on with us. We'll take a quick break, and post that, let's connect with our viewers and let's sort out their financial portfolios.